Hi, Steve Van Metre here, and welcome to your Monday Night Premiere, where we take about 15 minutes every Monday and Wednesday night trying to make sense of markets. I don't think that really make much sense today, but you have the largest single-day point move in the Dow Jones Industrial Average as investors bet the stimulus, or more stimulus from central banks, will immunize the coronavirus. This just goes to show that investors could care less about the risks. They're so focused on stimulus and the dream of what stimulus can do. Again, it's a fantasy because it doesn't solve all the problems. That investors could care less of whatever risks are going on in the economy because they believe that lower interest rates and money pumping from central banks, not that the Fed can, but from other central banks, can paper over any problem in the world. Now, mind you, this has happened at every peak of every market in history that the central banks have intervened. And it has worked exactly 0 times. And I will show you, if time provided, why more stimulus is not what everybody wants. They think it is. They really don't. But anyways, let's get into the topics of today. In terms of liquidity, market liquidity is very weak when looking at the NASDAQ McClellan Summation Index, down to minus 200 as of Friday. Minus 300 is the threatening zone of big sell. So what did we expect to see today? And you're right, buyers desperate to get prices back up, to get liquidity. Because remember, when stock prices rise, they create liquidity in themselves. So they were looking to do that, and they did in a big, big way. But let's take a look at how speculators or hedge funds are positioned in the market. Thanks to Hedgeopia, who provides this data on a weekly basis. We greatly appreciate it, especially because of all the cool graphs to make it easier to interpret the data. And so 10-year Treasury yield made a new all-time low as of last week, and as of Tuesday, speculators are only slightly off their shorts, meaning that you have 10-year Treasury yields flirting with 1% and speculators are deeply short still. You want to talk about where yields are going to go when speculators are long up here? They're going to go negative. In fact, when I saw this on Saturday, I was very, very excited because, in case you're wondering, Hedgeopia does post this on Saturday, usually in the mornings. And then I scroll down to look at the position on 30-year bonds, and they increased big increase in their short positions as 30-year bonds closed on Friday at record highs. So the market is desperate to short these positions because they believe massive amounts of inflation are coming. They believe what you're seeing in the bond market isn't true. Of course, they don't quite realize it's at the hands of the Fed. Let's keep going. Crude oil futures went up slightly. Speculative positions went up slightly as crude oil flirted with $43 a barrel, which is a very, very key support level. Keep in mind, as speculators bid oil prices and oil stocks up today, the Strategic Petroleum Reserve is going to release 15 million barrels of oil this month. This is a mandatory requirement based on a law passed several years ago. S&P 500 positions went up as of Tuesday last week as the market melted down. And we'll skip the euro. Looking at gold, we're still record or near record long. Gold futures, I guess they're down. Net longs are down 9% from record high. Not really down much compared to where they are at their peak. Gold went down. Remember, gold falls during periods of market illiquidity because gold is very easily transactable. So people that have gold that need to cover other positions sell it, and it's quickly absorbed by the market. Speculators went long increased their NASDAQ longs as the market sold off last week and backed off. Looks like they backed off their Russell futures slightly. We can barely see it under here as the Russell puked and found support. And the dollar dipped as speculators increased along. This kind of surprised me. The dollar should be rising, but sellers are just trying to bring the dollar back down. Weird kind of during the dollar liquidity shortage. And here we see volatility spiking And guess what? Speculators are still net short. So it just kind of goes to show that speculators are on the wrong side of this market as the Fed is draining liquidity. This is one of the key things to understand is the Fed is they're attempting to add liquidity in process of they're removing liquidity. It seems like this doesn't make any sense. Yes, it's opposite the way you think. In fact, this weekend, I saw an interview with Dr. Lacey Hunt, who in my opinion is the foremost expert on the bond market. This guy is brilliant. He's the foremost expert who is alive today. Now, he may not be he might say he's not the foremost expert, but in my opinion, of the people alive today, this guy is a genius. And I can't share with you the interview because it was on a private subscription service, but he did, in a matter of 2 sentences, say what I've been telling you is that central bank easing from the Fed does not ease until it does. And then in the meantime, it tightens. He didn't go quite that far, but that's what it implies. Now, he did bother to say how you can determine that. So let's take a look at what he had to say. And he said there's 4 things you need for monetary policy to work. He said, 1, you need the monetary base to rise. Well, it is not much, but it's rising at 2.86% per year as of January. It's not rising hugely, but it's rising. He said, next, you need total assets, at commercial banks to be rising. But he did mention that commercial industrial lending was rather weak. And there's a reason for that. So if we look here and we say, okay, assets at commercial banks are rising at 5.6% a year. You say, well, that's pretty good. Yeah, it's kind of below the average. It needs to be up here in this probably 7 to 8% range. I've said that before. Liabilities, which generally move right in line with assets, and you can see here at 5.66%, they're rising. They too need to be in the 7 to 8% range. So it's good. Assets are growing, liabilities growing, the monetary base is growing, but they're not growing fast enough. And he said the linchpin to the whole deal is the velocity or money or speed at which money changes hands needs to be at least flat. You want it to be rising if possible, but it's declining. So all that to say is monetary policy from the Fed is not working. It's like literally spinning its wheels. It's having no effect. And we know that because we're not seeing the economy turn around from it. What we're seeing is it tighten. And why is it tightening? Because the Fed's buying bonds. When they buy bonds, they take bonds from the bank. The bank now does not have sufficient collateral for loans. Lending conditions tighten. As lending conditions tighten, banks originate fewer loans. The year-over-year loan growth falls. Year-over-year loan growth rate falls, and the economy tightens. And when does it stop? When the Fed eases enough. And we can kind of see that in some of the charts. So let's go and find some of those while we've got a bit of time left. So I thought that was pretty cool that probably my hero of the bond market, who I've studied everything I could find that the guy talks about, pretty much validates that monetary easing doesn't ease until it does. Now, they asked him what his target was on, say, 10-year Treasury yields or 30-year Treasury yields. He says, I don't give targets, but he only manages government bond fund. That's what he does. He only buys and sells government bonds, and he said that his duration, or how much risk, is over 20 years. Well, guess where my portfolio is sitting too. So you can tell where he thinks interest rates are going much lower. He just wouldn't say he wouldn't go out on a limb and say, here's my price target, but he's invested as if they're going significantly lower. So let's take a look at how the market closed out today. We can see the Dow, just huge, largest one-day point move on pure speculation the central banks are going to somehow paint over the coronavirus. We see big moves on the S&P 500. We went from support to busting through resistance, overhead resistance here at the dotted purple line. NASDAQ was up. Everybody's excited. Now, what's interesting, this is a volatility ETF, which you will never trade. It didn't sell off that much. It was only down 3.4%. So you can see today's move in the market there was a lot of volatility, a lot of big price moves, meaning the person buying stock and the next person, between the one person and the next, there was a larger difference in price. One of the big keys to look at is the Russell 2000, and we can zoom out a bit on the Russell. And I think last Friday we talked about how it was sitting on this key support level, and you can see it found buyers here. So it found buyers right here in this 1460 range where buyers have been since September 2017. So there you have it. Buyers are still interested in buying here. When they run out of steam, then you'll see a deeper sell-off down to the 1360 level in the Russell. In the meantime, market is bullish. Now, we can't really look and see what happened with the Treasury market because it surged in late day trading. In fact, 10-year Treasury yields closed at 1.15%, so right about here where my mouse pointer is. If we look at the bond market, you can really see in today's price action, here's where the Fed was buying some 2-year Treasury notes in late trading. So they were pushing the bond market up, pulling liquidity out, and all of a sudden just this massive panic selling in the bond market at late day as investors decided, hey, all the central bank easing is going to be inflationary. But for some weird reason, Steve keeps saying it's not inflationary. Okay, well, let's go explore that. Again, I think this is necessary to do. And let's take what I'm going to look at here just so you can see. These are 13-week Treasury bills, the closest proxy to the federal funds rate my system will do. And if I had federal funds rate on there, it would look almost the same. Let's overlay the S&P 500. Let's zoom in a bit on a weekly chart. Let's go back and look what happens. Here is the 13-week Treasury bills going down. Here is stock prices going down. So you can see yields are falling, stock prices are falling. Now we go to this bottom, and we see yields start to flatline, stock prices move up. Now, what did we say with the, remember, I've been recently called the arrow man. So remember, when yields are falling, stock prices are falling, validates a bear market. Then at the bottom of markets, what happens? Stock prices start to lead yields. And they did. So we see stock prices started to rise as yields bottom out and yields fall. Validates this as a bottom, validates this as a bull market. Now we get up here, yields roll over and start to fall. Stock prices fall. That validates this as a bear market. How about the peak? Yields peaking ahead of stock prices. Validates this is a peak. Down here, stock prices rising, yields artificially suppressed by the Fed. Validated bull market. So what do investors want now? Investors want higher stock prices. They think stimulus will lead to higher inflation, higher yields. But what have we learned? When the Fed cuts rates, yields go down. When the Fed tightens and raises rates, yields go up. So if yields are going to go down, right? Yields going down, what's going to happen with stock prices? Yields going down, what's going to happen with stock prices in purple? We can see this relationship all throughout history. Except, let's see, it's really hard to see right in here. This is 93, so there's a little recession here in 94, and we can see yields kind of flatlining and the market kind of hiccuping here and then going up from there. So what does that mean if the Fed were to come out this month and cut the federal funds rate 50 basis points? What is it going to mean? It means stock prices are more likely to go down than they are up. Because when the Fed cuts, stock prices will fall. If you want to know why retail investors, why professional money managers always get this wrong, is because they get it stuck in their head that stimulus is bullish. And they get it stuck that way because they are not paying attention to how the markets actually work. And if they saw it, and you saw this chart, which you now know, and you've seen at least several times because I've shown it, right now, you want to buy bonds, sell stocks, because everyone else is buying stocks and selling bonds. And now you know what the smart money knows is that yields, when they go down, stock prices, they go down with them. I'm Steve Van Metre. Thanks for taking your time to watch. We'll be back Wednesday. We'll see what other volatility fun this market will bring us. The content of this video provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.